tappers. Okay, so as I also explained, so what we expect to know is just the first thing to do when you go to the market is you have to identify your direction of buyers. Are we buying? Are we looking for buy orders, or are we looking to sell the market, right? So, and we normally use the higher time frame to identify our direction of bias. So if you are looking to swing trade, we use monthly or maybe weekly. But if you are looking to maybe to trade, you can use 4 hours or even 1 hour. But don't you look at the direction of bias using, let's say, lower than 1 hour, because most of that market is so noisy. But I like the fact that we use the monthly because it determines the direction, because that is the commanding. So because if maybe monthly is selling and you enter in a daily maybe and you want to hold your position for 4 days, so and maybe you want to buy in daily, it means that the monthly time frame has more power to change the direction of the daily. So that's why we like start analyzing our market using the daily. So we want to identify if it is an uptrend, we want to identify something like that one, pull back, then the market breaks above the high, it pulls back to grab liquidity, and then it moves. And then as I have explained before, that we want to identify the area of liquidity. After we have identified that our market is breaking the higher highs, we want to identify the area of liquidity. And we say that the area of liquidity is where there is unfulfilled orders from this, let's say, the large organization. Yeah. So we want to align ourselves with those organizations such that if the market grabs liquidity in that area, fills those orders, at least we can rally with that, with those movements. So, and as you can say, if it is an in uptrend, you mark the low that caused the break of market structure. You mark the wick there. Then you mark the body where it was broken. You mark the body. So this area, this is where we expect, if the if our market change, maybe if you go to a lower time frame, let's say daily, and you see a shift in market structure from buying to selling, then you can look for opportunity to sell until the market comes near somewhere here. Then you exit, and then you look for opportunity for market to shift in a daily time frame from selling to buy, and then you can buy and expect to break the high. So this is what we want to identify. So once you have identified the directional bias, we want now to go to lower time frame, that is daily, and then we look at maybe at areas of liquidity where at least we can find our potential entry. And then also why we go to daily is because we want to lower our risk as much as possible. If the risk in daily is not maybe so friendly to our dollar account, then you can go down to 1 hour to look for the area of liquidity. And if the stop loss is too huge, then you can go even to 50 as possible. So that is our chart. Because of the time, but we are remaining with 20 minutes, of which it is not the USD. So we don't want to go back, going backwards. That's not, I can start from here. So the market low, it broke below this low, with this to pull back to try below the low, then the market below the low, then the market broke, that was failed by this candles left up before the market broke this low, break below this low, but it the market tried to break below this low. Okay, let me mute you. Okay, no problem. Let me mute
It's
you.
raining here.
Okay. I have muted you, so you can just listen. So I don't know if you'll be able to listen, but I'm recording such that if you miss to hear anything, then I'll share the video. So the market tried to the green candle, but it failed. Then the market pulled back. Then the market broke. Then the price tries to, of which it was not an area, so the market broke below the liquidity area. Then the market, boom, went down. So we want to analyze this leg, our area of liquidity, because the market broke below this low. This one can close below this point. So we mark that point as straight line. So our area, we want to mark our area of liquidity below the here, which was broken. Then we mark the high. Then we mark the high. This region is the area of liquidity. So you can this one. So Okay. So today you have come to the market, and this is the market that you are seeing. So yeah, we expect the market to come and break below this low, but the market has not reached that point. So, and as we understand, the market will not come direct and break that market. It will be moving in impacts, then retracement, impacts, and then retracement. So this is where we are looking for the market to reach and break this point. But the market does not move in a straight line. It moves with impulse, then retraces, impulse, retraces, that way. So, and we have identified the last break of structure was this point, right? Then we mark our area of liquidity, which is the body and the high. Then we go to, so we can mark our current price. So let me say, okay, sorry, let me use the straight line, this one. So this is our current price. So we want to go and observe what is happening at this current price to see if there is any signal in daily. So this is our current market price. So we move back to the lower time frame, which is daily, to observe what is happening there, if there is any signal from change of trend from uptrend from downtrend to uptrend. So we come, this is where our price is currently. So we try to analyze the price action here. We want to return to this area of liquidity so that we can sell. So our market, as we can see, came down, retraces, tried to come down, but failed to make the lower low. Then the market went up, failed to make a new high because this was the high that we were expecting to be broken so that we can signal the uptrend, but it failed. Then the market came down, break below this low with this candle. Then the market went up, retraces, went up, another trend, but failed to break below this high. Then the market broke below, it failed to make the break. The break was happened here. Then from there, the market retraced. Then the market broke below this low. Then the market returned, failed to break above the high. Then the market broke below the low. Though it's not clear, it is cluttered. Then the market went up, then broke below the low. Then the market went up, broke below the low. So far the price action here, it's not understood. So we can go to, so if we can see, we can, let's say we rely with the previous high, which caused the broke. So we are expecting daily to shift at this point, so of which it is close to our area of liquidity. So this point, so which is very close to our area of liquidity. So at least we can go down to, let's say, 1 hour and see if we have any signal. So we can go to 1 hour. Fail. I've not paid for this thing. I can't go lower than that one. Oh my God. Oh my God. Okay. So let me cut. And let me cut. I think it does not allow me to go back. I don't know if it is this point. And this point. Let me assume it is this point. It is not. I'll have to pay for this thing. Even if there is a dollar, even if the dollar has appreciated against the shilling, I'll have to pay. So we were here, so let me break. So let's assume we were at this point. Yep. Because it's so hard to analyze the market because, yeah, okay. So plain is that at that time when I was analyzing, it was at this point, right? 1 hour to see if there is any shift in market structure. And if 1 hour could have validate our shift in 1 hour to show that at least if 4 hours shifted to confirm the shift in 1 hour, then that will mean that if 4 hours shifted, that means that the market has gained momentum, and that's a proof that the market have found enough force to go and break the daily structure. And as you can remember, it is structure, so of which we were expecting, if market shift, that could be the right shift, that then with direction from downtrend to uptrend, that's higher low that made the broke of structure. But since then there are cards here, and so this was the clear structure for shift of structure. So view our market, so the market retraces, and then after that one, the market move with an impulse with green candle, leaving some, this low and this high did not touch, so there are some voiders. So if you find out where will our market come from, so we find our new formation or maybe inside formation structure. So our inside formation or maybe area of liquidity, we mark the body here, that one. These are our area of liquidity. So the black line to this low black line there, this was our looking to. This was the where the price was, and now this is low. So if the market will come back from this point coming down, it will just come in, up to here, and then to find the force to go into and find the up to the monthly area of incapacitated by this trading view, because we cannot go below 4 hours. So I think we can just use this. We can just imagine, because these are at the end of the day, these are demo. We just end our trade here. Then our small trading, at least, because you can go back at least and see how what 15 minutes we're doing, or maybe if we'll make it to subscribe, then we can just refine our trade. We can go even to up to 2 minutes, 3 minutes, and then we can find out that our entry should be some around here. Then or maybe even you find that your entry is here. Then you find out that the distance between this and your stop loss is just maybe 5 pips or maybe 10 pips, no? But for now, let's use this one, because our pip is 750, which is a lot. Yeah, our pips is 75, which is a lot for us who are trading dollar account. So, and where will be our target? So our first target, we have to go to our area of liquidity, monthly area of liquidity. So we go to our area, our monthly area of liquidity, and analyze. This was our monthly area of liquidity. So we want to analyze price action from this point to this point to find where, if this market retraces to this point, grabs liquidity, where will it go up to? It will go to somewhere here. Then after that one, it will start selling. So we analyze from here. So the last higher low that was valid was this point, right? This one. So the market came, retraces, tried to break below the low, but it failed. Then the market broke above the high, but we expected it to break here. So the market broke by using this candle. Then from there, the market went up. Then the market came and broke below this low using this candle, but failed. So the market came back, tried to retrace, move to the top, then come down, retraces, come down, retraces. Then this market grabbed liquidity inside here. Then the market broke below the low. Then this was our low that we were looking, because this was a valid low before the market retraced back, right? So this was the low that we were looking. If market break below this low, that's a confirmation that our market has gone down to strong bearish. So before this break, where was our area of liquidity? This one was this one was grabbed. Then this one was not clear, because this market retraces to, as you can see, this green wick, it went inside here. So we can mark this clean candle, because as you can see, this was a very strong bearish candle. So we can mark that area. That's our first area of take profit. We can mark here. This is our first area of take profit. And then we can mark this one as our stop loss. So this market will aim to tap it there. So that is 273 pips. Then that's a 200 and what? This is a 273 pips. So that's your average. And then you can go down to 1 hour to try and refine this, and you can find out that maybe your market will turn from this point. So you'll be maybe losing, let's say you'll be risking maybe 7 pips. So then when the market reach that point, we sell, because we understand that our general bias is selling. So we can sell at this point, but for now, because we have not refined, let's put our sell order here. Then our stop loss above that high, Our stop loss, I imagine again, it is 75 pips. So I don't know what a coincidence. So, and where will be our target for selling orders? Our selling order, we target the low. So as you can see, our target is now 484 pips. So that's a lot of money. So then we can start playing, because now we have identified our buy order, our daily area of liquidity for buy order, and our daily area of liquidity for sell order. So we can play our now the market comes, then grabs our liquidity. As you can see, our market returned back to our area of liquidity, our daily area of liquidity. As you can see, if we could have refined to daily, we can find out maybe we could have ended at this point, then our stop loss at this point. So our market grabs the liquidity and immediately moved, then break above the high, then it formed another new area of liquidity. So we expect this market, it will come up to it will retrace up to this point. So this is our new area of liquidity, right? So if maybe I could be trading today, I could have marked this area. I could have marked this area, this body, this area, and then our stop loss will be somewhere here. Then we can go to 1 hour to refine to our entry. So we expect this market will come inside here, then find the force to break the high and enter into our monthly area of liquidity. So that's our analysis for today. So we'll watch out. I'll not clear this. Then I'll see what will happen. So I can just put another buy order here. I can put another buy order here because I think this is still valid. So I can put our order here, our stop loss here, then our target. Our target is at this entry point there. So we'll just leave our markings that way, and then we'll try and see. But I think we can play here. We can refine this point. So let's refine this point. So let me mark. Let's refine this in the 1 minute that is left. So let me refine that on 1 hour, because I think here there we can be allowed. So okay. So as you can see, our market make higher, low, broke above the high with this candle. Then the market retraced, tried to break below the low, but failed. Retraces back, break below the low. Then the market retraced, higher low, broke below that low, tried to make below the low, but failed. Then I think since then there is no other valid break. So this was our last low. So there's no break. So our shift happened at this point. Our shift happened at this point, at that point. So we can analyze here, but it is not clear. So we can go to 15 minutes. Let's go to clear. So if it is not clear, you don't force them and you'll find out that it is clear. So I'm sorry. Why is this thing? Okay. I mean, so much. Why is it not moving? Surely. What's happening? Price action. Yeah, as you can below the low. I think this notification running out of time, but failed to break below the low. So this the market tried to end. So our valid break of structure happened here. So this was our valid break of structure, this point and this point. So that point, the T, and then we have this other point here. Have this other clean point of liquidity. Go to lower time frame, that is go to 5 minutes and identify between this liquidity. But I think for this, because of go and look at it on my own. Thank you, very important. Thank you for joining. And we move every day. We try and as much as possible to increase our accuracy by 0.05%. Okay.